join over the first few minutes, and then we will go ahead and get started. All right, great. I see him filling in now. Give it another moment. All right, we can go ahead and get started, and I'm sure people will continue joining over the first few minutes. So good afternoon, everyone, and welcome to our Q2 2024 Financial Outlook and Portfolio Update. We appreciate you joining us today, and we hope to provide you with an informative presentation, as Steve always does. We encourage you to ask questions. So if you have anything you want to ask Steve, we ask that you please submit them in the Q&A feature that you have in your Zoom toolbar, and we will get to them at the end of the webinar. And with that, I'd like to introduce you to Steve Galli, our Chief Investment Officer, to take it away.
Thank you very much, Katie, as always, and thank you all for joining us. Hopefully, everyone has been having a nice May so far. And, you know, a nice May, it certainly has been, as we are now seeing the equity markets hitting all-time highs. Yesterday, both the S&P and the NASDAQ index hit all-time highs. Basically, they've never been higher, and apparently they're hitting new highs as we speak right now. So this certainly is a very exciting time in the equity markets, and I also think it's a pretty exciting time in the bond markets too. So we'll be discussing some of that today, and then we'll be discussing, you know, what we're thinking in regards to portfolios. And then, of course, at the end, we will always have time for some questions. So please don't be shy and ask away. So we always like to take a look at some of the headlines. I think, you know, the financial media always likes to over-dramatize things. You know, this was from this week's Barron's about, you know, stocks, you know, being on a nice run, but when the earnings reports come through, well, maybe stocks are going to pull back. Well, so far, earnings have actually really been strong. Earnings have consistently surprised to the upside, meaning that all the analysts out there who spend a lot of time trying to predict these things, the companies have actually done better than those predictions. So that's been a nice development. This is a recent print from Bloomberg about how, oh, we have to worry about how there's all this dangerous debt looming over a lot of companies out there, and in many cases they're referring to you know, commercial real estate debt. But so far, the bond markets have really shrugged that off and have also been really strong. And you know, a recent headline from the Wall Street Journal has talked about, you know, how the Federal Reserve has had a really hard time getting inflation back down to their target. And a lot of that has to do with the housing component of inflation, which has remained stubbornly high. And I think that is actually still the case, although yesterday we did see signs that inflation was cooling more than what was expected. So that was actually a pretty good sign, both for the market and for the Fed, in the fact that maybe they are making more progress than we thought on the inflation fight. So if we take a look at actually what's happened so far this year, and this is actually sorted by various sectors of the market year to date, and this is basically through yesterday, we can see that it's still been a lot about growth stocks, right? So if you look at the S&P 500 and you just look at the growth stocks in the S&P 500, they have led the way, up over 15.5% through yesterday. That's a really strong return. That's a great return even for an entire year, let alone just for, you know, through mid-May. Tech stocks have actually done also quite well, up over 10% year to date. The value component, right? And what are value stocks versus growth stocks? Value stocks tend to be a little more conservative. They tend to pay higher dividends. They have more predictable earnings. So they're a little less exciting. and they have not kept pace with the growth stocks, but certainly nothing to sneeze at. A 7.5% return year to date, that's also pretty good. So it doesn't really matter how you cut it. Even small cap stocks, as represented by the Russell 2000, are up almost 5% year to date. So in general, stocks year to date have been great. They were also great last year. So the momentum has continued. Bonds this year to date, not so much. Unless you were basically only in high yield bonds, which is a fancier way of saying junk bonds, which have been up so far this year. Most other bonds have actually been in the negative this year, munis, corporates, and governments. And we'll discuss, more about bonds in a bit. But that has been actually a little bit of a disappointment this year. And a lot of that has to do with the fact that the Fed has not signaled they are cutting rates anytime soon. And bonds love when rate cuts happens, because when interest rates go down, bond prices go up. But that has not happened this year so far, not yet. So I always like to take a look at where we were in terms of market valuations. And everyone knows this is one of my favorite slides, because it basically shows that, where were we a year ago, right? And the dotted lines here, the middle dotted line, this is the 25-year average of the forward price to earnings ratio of the S&P 500, meaning how much on average do I have to pay if I want to own a stock in the S&P? And basically, I'd have to pay about 17 times earnings. So basically $17 for every dollar of earnings that I'm buying when I buy a stock. That's the average over the last 25 years. And last year, we were somewhere around that average. We were actually around 18 times forward earnings. So it wasn't cheap, certainly, but it wasn't really very expensive. So you could have made an argument last year, and we actually did, that it wasn't too bad of a time to get into stocks. Stocks weren't overly expensive, so we were pretty comfortable with the stock exposure last year, and certainly that has paid off. Now, where are we right now? Well, as of yesterday, we are no longer in what I would call the comfortable territory of valuation. Comfortable territory meaning these two outside dotted lines, the market 2/3 of the time tends to trade within these two dotted lines, right? So in between 13.5 forward earnings and 20 forward earnings, or 19.9 to be exact. And where are we now? We are getting close to 21 times forward earnings, meaning for every dollar of earnings I want to buy, I have to pay about $21 for that dollar of earnings. That's kind of expensive. It's certainly expensive relative to the last 30 years. And the only other time it's really been higher than that was actually at after the pandemic market surge. It reached close to 22 times. And back in 1999, when we had the dot-com frenzy, and then, of course, the dot-com bubble that burst after that. So you can make an argument that stocks are pretty expensive right now. Now, that doesn't mean that this can't come down, and we'll talk a little bit more about that. But I always like to actually look at, well, what are people feeling? What in general are the average investors feeling in terms of confidence about the market? And interestingly enough, right now, relative to the last 50 plus years or so, people are actually not that confident about the market. Maybe because it looks kind of expensive, people aren't that excited about the market. I would actually argue also because there are things happening in the economy and in the labor market that are perhaps making people less confident. But the interesting thing about this slide is that when confidence is not high, the market tends to do really well. It's like a contrarian indicator. So the point of this slide is that if you invest at the peak of confidence, and it showed these blue dots above this dotted line are the peak of confidence over the last 50 years, and the blue dots below this dotted line are the troughs of confidence over the last 50 years. Investing when people aren't confident or when people are feeling pretty pessimistic, that's always paid off. You really want to get in the market when people aren't feeling too good. And interestingly enough, even though markets are at an all-time high as we speak, people somehow are just still not that confident in the market. So let's dig into that a little bit, because that's kind of perplexing. So if we look actually at the labor market right now, we know that the unemployment rate is still at a pretty low level. Not at historic lows. It's come off the historic lows that we saw over the last few years, but it is still quite low. But that's because the labor market is starting to cool. Now, this is a pretty busy slide, and I do have a lot of busy slides in this presentation, so you're going to have to forgive me for that, but I'm going to try and point out what are the most interesting facts here. And the bottom line is, if you look at the small business hiring plans, which I think is a great indicator of the health of the underlying economy, because small businesses employ, the large majority of our population, they're not hiring as much. We can see a pretty significant downtrend in small business hiring. And by the way, the gray bars in all these charts represent recessions that we've had in our economy. And so that's something to keep in mind, because usually when we have downturns in these charts, they coincide with recessions. And this shows what's happening with temporary employment. In other words, when temporary employment hit a peak before the dot-com bubble burst, it came crashing down, and that signaled a recession. Same thing happened in the mid-2000s before the great financial crisis. And the same thing happened actually right before the pandemic crisis that we had. But as you can see right now, temporary employment is also coming down. Wage growth in the bottom left chart here. What is it doing? It's coming down. And on the bottom right, this is an interesting rule by economist, I believe she was out of the University of Chicago, named Claudia Sahm, who basically said, when you have an overwhelming number of states where you have an unemployment rate rise by more than 0.5%, that usually means you're going to have a recession. And so the point of this chart is that rule, meaning there are a lot of states that have actually seen their unemployment rate rise from the lows by more than 0.5%. And that tends to be somewhat of an ominous sign, and generally has been a pretty good predictor of a looming recession. So, the discussion about, and this is another chart showing how job openings, as if you want to take a look at popular websites that post jobs like LinkedIn and Indeed, they're down. And so this raises a question, if labor demand is kind of weakening, why has the unemployment rate still kind of hovered close to historic lows? And the short answer is that labor demand has simply not been the constraint to employment growth. Labor supply has been the constraint. And the surge in job openings during the pandemic, that allowed almost anyone who lost a job to easily get a new one. That kept unemployment from rising. And in the meantime, the rebound in labor participation, meaning people who decided to get off their couch and actually start working, they were voluntarily not working, and then they decided to start working, that actually increased dramatically. And strong immigration flows post-pandemic have also increased the number of people eager to work. But the bottom line is, firms have not been replenishing those job openings, and so they have not been converting into actual new job growth. So I think this is really important because, as the job market goes, usually so does the economy, and the job market tends to be the last indicator that kind of really tells us when a recession is close. It's kind of the last indicator to kind of give it up and to say, okay, now we're in trouble. So, and I think the point here is that we really are seeing signs that may be happening. And so what's the knock-on effect to the consumer? Well, the savings rate right now is at a 5-year low, right? The average savings rate over the last several years has been over 7%. We are now at less than half that. The average savings rate is, in the US is basically close to 3%. That's not good. And one of the reasons behind that is that all the excess savings that people built up during the pandemic, it's pretty much gone. So that means the savings rate is probably going to have to go up, right? Because people need to save money in order to have, a cushion in case of emergencies and whatnot. And if the savings rate is going to come off what is now a quite low point, well, that means less spending, less consumption. Less spending and less consumption usually means an economic slowdown. So that's something to keep an eye on. And of course, this is showing up in the fact that credit card debt is getting much higher. And more troublesome, credit card delinquency rates are now back at levels that we haven't seen since 2012. So the really disturbing thing here is that even though we are back at 2012 levels, meaning delinquency in credit cards, the unemployment rate back in 2012 was over 8%. The unemployment rate now is basically half that, yet we are still seeing really high credit card delinquencies. And it's also happening in auto loans, by the way. That, to me, is a troubling sign. And so what do banks do as a result? Well, guess what? Banks tighten lending standards. Banks see credit card delinquencies go up. What do you do if you run a bank? Well, we better raise the rates that we charge on those cards to make sure that we're covering those losses. And that's actually what's been happening. As a matter of fact, credit card rates now are at some of the highest levels they've been in history, averaging sometimes over 20%. So for all of you out there, I think that means you don't want to be running up your credit card bills paying those types of rates, right? So, and that's happening both on the personal loan side at banks. It's also happening with new car loans, and that inevitably slows down economic activity. If you have to pay a lot more to borrow, you're going to borrow less. And so that has really put the Federal Reserve in kind of a difficult position, right? In that, ever since the great financial crisis in 08, inflation did run well below trend, to the point where, after 15 years of well below trend inflation, people kept saying, well, I guess we never have to worry about inflation because I guess the Fed or the government can run up as much debt as they want and it won't be a problem. Until it became a problem, and now inflation is running above its historical trend. And so a good argument can be made is that even though the Fed has raised rates dramatically to curb inflation, people are still feeling it. And this is kind of an interesting point here, is that even though the Fed started their hiking cycle in March of 2022, in the 2 years since that dramatic hiking cycle, inflation has still gone up by another 8.6%. So the Fed has a tough job because inflation is still sticking around, but we're seeing kind of those problems start to creep into the economy in terms of the labor stats we were looking at, credit card delinquencies, etc. And, this is actually what the yield curve has been telling us all along. So this chart is actually showing us the 10-year Treasury bond in the red line and the 3-month Treasury bill in the blue line. And back in October of 2022, what happened? The yield curve inverted, meaning you could get higher returns from a 3-month T-bill versus a 10-year Treasury bond. And that has persisted ever since. And the inverted yield curve tells us that a recession should happen, because the only reason the yield curve would be inverted is if people expect that in the future the Fed will have to cut rates as a result of a recession. And if they do cut rates, that means that these 3-month T-bill rates will drop dramatically below the 10-year rate, right? So the bond market has been telling us for a while now, yeah, we kind of see reasons to believe we're going to have a recession. And let's not forget, 2 years ago, back in May of 2022, and that really wasn't that long ago, when you bought a 1-year treasury bond, you were getting 2%. And this was a nice, normal sloping yield curve. If you bought a 10-year treasury bond, you were getting close to 3%. Now, that wasn't that great. I mean, but it was still a normal sloping curve. But that's a lot higher now. Now, 1-year rates are well above 5%, and the 10-year treasury bond is now well above 4%. So rates now are a lot higher. And we talked about this a little bit in terms of why that makes bonds a lot more attractive today. Because rates are a lot higher, investing in bonds has a really nice risk return potential moving forward. Meaning the upside of bonds moving forward, and this is in my opinion, is a lot better than the downside, because rates probably aren't going to move up much, if at all, from here. If anything, they're going to move down. And when rates move down, bond prices go up. And even if rates don't go anywhere, even if they stay exactly where they are, you'll still be getting a nice return on your bonds, which right now, depending on the bond you own, is anywhere between 4 to 6%. And you can impress all your friends at a cocktail party if you want to talk about why bonds are so cool, because right now a lot of bonds are positively convex. What does convexity mean, and why do I think that's important? Well, convexity actually tells us what happens to bonds given a movement in interest rates. And positive convexity basically means that a bond's return potential is lopsided, meaning if rates go down by 1% versus if rates go up by 1%, you would think all things being equal, it would affect the bond the same, right? If rates go up by 1%, that's usually bad for bonds. And if rates go down by 1%, that's good for bonds. And it should be about the same. But actually, that's not the case now for most bonds. Now, if rates go down by 1%, bond prices will go up quite nicely. But if rates go up by 1%, they won't go down as much as they would have gone up if rates went down. So in other words, the upside is better than the downside given an equivalent move in interest rates. That is a great situation. I mean, if I'm a gambling person and I want to make a bet and I don't know what's going to happen in the future, but I know that interest rates might go up or down, and let's say there's a 50-50 chance that they go either way, but I know that if they go up, I'm going to be way better off than even if they go down, I'll take that bet. So let me give you an example of a bond that's negatively convex. Those are mortgage bonds. Now, for those of you who aren't familiar with mortgage bonds, they're actually quite interesting, because what the investment banks on Wall Street do is they will take thousands of individual mortgages. So if you go to a bank and get a mortgage, the bank actually usually doesn't keep that mortgage. You know what that bank does? They sell it to another bigger bank. And that big bank buys all those mortgages from all these banks and puts them into a big pool. And it carves up that pool and sells them to big institutional investors who buy them. And so those institutional investors then collect in aggregate all the mortgage interest payments that all those individuals are making on their mortgage loans, which actually sounds pretty good, right? But the reason mortgage bonds are negatively convex is because if interest rates go down, what do individual homeowners tend to do? They refinance their mortgages. So if I'm holding a mortgage bond and interest rates go down and I'm thinking, this is great, interest rates went down, that means my bond price should go up. It doesn't really go up that much, because what happens is a lot of the underlying mortgage holders refinance at lower rates, which means as a mortgage bondholder, I get my money back when I don't want to get it back. And if rates go up, that actually is really bad for mortgage holders, because then what happens? Well, then people never refinance. As a matter of fact, their odds of refinancing go down dramatically. People hold on to their mortgages a lot tighter, a lot harder, because they don't want to refinance at higher rates. And so then as a mortgage bondholder, I'm stuck, right? I'm stuck holding a mortgage bond that's paying lower than the current rates that I probably could get out there from a newer bond, right? And so that's an example of negative convexity. Now, I'm not saying mortgage bonds are bad, but most bonds today have positive convexity. And so the example on this slide, I'll just point out to be extra clear here, is look at what happens with a 2-year treasury bond. 2-year treasury bonds are nice, right? I give the government money for 2 years. They promise to pay me back in 2 years. And during that time, I collect a nice coupon. And right now, the coupon on a 2-year is around 4.8%. So I give the government money for 2 years and I collect 4.8% per year. So if interest rates go up during the time I hold that bond, that means the bond price will go down. But this is telling you the bond price will only go down by about 3%. It means that my return on the 2-year treasury will actually still be positive. Yes, I won't make as much as I thought I would. I won't make my 4.8% coupon, but I'll still make about 3%, even if interest rates go down by 1%. So that's not too bad. I mean, even if interest rates go up by 1%. But if interest rates go down by 1%, then not only do I make my coupon, but I can also make money if I sell my bond, because everyone wants to buy my bond if interest rates go down because my bond's more attractive. So that's the point. The upside is a lot better than the downside. That's the type of thing I want to own. So that's one of the reasons why when we talk about portfolio allocations, we like bonds. Okay. So it seems that we had some reasons to be pessimistic, right? Market seems expensive. There seem to be some issues in the economy that are looming. But, and this is a really busy slide, but I think it's really important to point out that this recession that everyone's been talking about hasn't materialized. As a matter of fact, a lot of people really aren't talking about a recession very much, despite the fact we have this inverted yield curve. So why is that happening? And one of the reasons it's happening is because we have had one of the largest public to private transfers of wealth in history. We now have a lot of money that has been funneled into higher yielding investments. So that dynamic, the government flooding our economy with cash, which, by the way, usually ultimately ends up in the hands of higher income cohorts in our economy, they funnel that excess cash into higher yielding instruments, which creates more wealth. And that massive infusion of wealth from the public sector to the private sector has allowed the economy to keep humming along. And it has allowed inflation to stay sticky since there's still a lot of spending on services. So I think the interesting point here is that, and if you look in the lower left, for over 30 years, on average, consumers had a lot of debt. But because, and usually when consumers have a lot of debt, if the Federal Reserve increased interest rates, that would generally hurt the consumer and really slow down the economy quickly as well. But the reason that actually hasn't quite happened so much is because we've had so much cash added to household balance sheets in the last 3 years, consumers on average have no net debt. And so the ability of the Fed to slow things down has been diminished. So if consumers on average don't have much debt, then the Fed raising rates doesn't have much effect since people don't have that much debt anymore. So that is really what has been an interesting dynamic occurring today. And when you do keep rates this high, higher income spenders become the net lenders to the lower income cohorts. So as you can see, if you are fortunate enough to be a household in the top 10% in terms of income, which is in this red box right here, your total net worth dwarfs all the other cohorts combined. And this is who is benefiting the most from higher rates, because they are taking their excess savings and they are investing it. And those investments are now paying a lot more because of the higher rate environment. So in a perverse way, the Fed, by having rates where they are, is almost causing a certain amount of inflation. So that's kind of some underlying dynamics that I think are really fascinating, which is kind of explaining why the Fed is in a really difficult spot right now. So, in fact, if you take a look at like the 55 and plus year old age brackets, they're spending money like crazy, and they're spending money on things like travel, leisure, eating out. And that is why inflation has stayed sticky. And those are the parts of inflation that has stayed sticky, making the Fed's job to fight inflation that much harder. So this is actually extended also to corporations. This is telling us right here on the upper left that over 2/3 of high yield debt was issued in the last 10 years when interest rates were really, really low. So corporations, similar to people who got really low mortgages a few years ago, corporations are sitting pretty on all the debt that they issued when interest rates were low. So that's one of the reasons the bond market is pretty comfortable with the current situation, because corporations, on average, their net interest payments are down. So corporations are sitting on really great debt issuance. They're not worried. So we really have phenomenal credit conditions now. And because the interest rates are so much higher than they were just a couple of years ago, people who buy corporations' debt, they're getting paid a really nice coupon to own that debt. Now, let's not forget about some equity excitement too. This actually shows that if you take a look at some of the largest tech companies in the world, and we can imagine who these might be, like the Amazons and Googles and Microsofts of the world, they're spending on research and development. They're spending on capital expenditures, and their earnings absolutely dwarf all the other companies in the index combined. I mean, this actually shows that only like for example, a Google's earnings dwarfs all the 4 biggest automakers combined, right? Their free cash flow dramatically higher. And that is going to just simply seem to continue. And that's why people have been so excited about some of the big companies out there in the index, the Magnificent Seven, to name a few, as well as a lot of the tech companies. And they're also buying back a tremendous amount of stock. Apple is repurchasing 23.5 billion of their stock. They're announcing another 110 billion authorization for the rest of this year. Google is going to repurchase 70 billion of their stock. Meta the same, Microsoft the same. This is going to continue because these companies have serious competitive advantages, and they are maintaining those competitive advantages. And that's one of the reasons why we think it's really important to have requisite exposure to these companies. And we'll talk a little bit more about that. So taking a step back, I think it's important to think about, what's been happening in the tech world. And in my lifetime, I think, I've actually lived through 4 major tech innovations. The first was the internet, right? And we know what happened there. I mean, we had companies that were the darlings of the internet: Sun Microsystems, Netscape, AOL. Those companies don't exist anymore, but they were certainly really important in the internet era. And then the bubble burst back in 1999, 2000. The next big innovation was the mobile phone. This was the incredible concept of basically putting the power of what used to be in an IBM supercomputer into the palm of people's hands. And that ushered in the next big tech revolution post the internet revolution. What happened after that? Well, we had cloud computing, which is allowing many of us to work from home seamlessly. It's probably allowing many of you to watch this webinar easily, because cloud computing allowed us to keep everything in a centralized place, not actually on hardware in a physical a physical location right under your desk. Huge revolution. And what's happening now? Artificial intelligence. This is the fourth revolution that I believe has just begun, that we are living through right now. Now, some might be arguing, you know, aren't stocks that are doing AI or AI related stocks overhyped? I would say that actually the technology of artificial intelligence, in my opinion, is probably underhyped. Some stocks might individually be overhyped, but I think in general, the technology is not. And if you think about it, back in the internet era, when we were at the dot-com bubble, stocks were, the NASDAQ index, which represents mostly technology companies, that was trading around 60 times forward earnings. The NASDAQ now is only trading about 22, 23 forward earnings. So we are not near the type of nosebleed tech valuations that we saw during the internet bubble, for example, in 1999. And so many things are happening so fast. I mean, OpenAI, which is the company behind ChatGPT, which is, you know, an incredibly powerful artificial intelligence sort of companion on your desktop that you can ask almost anything and it will spit out a pretty good answer. OpenAI just introduced the concept of memory for its users of that product, meaning that not only will ChatGPT give me a good answer if I ask it something, but it'll actually start to remember the type of things I ask it, and it'll start to remember how I search and what my preferences are in terms of what I do with those search results. And that, to me, is just getting started in terms of the individual power of tools like that. As a matter of fact, I was reading a research report from Goldman Sachs the other day. They actually expect the US power demand, you know, generated by utilities, that's going to accelerate dramatically over the next decade by anywhere from 2.5% to 3%. That's compared to the last decade where US power consumption didn't move at all. Because in general, as our technology gets better, it used to be that our power consumption would get lower, right? But because of the AI revolution and the need for so much power for all these computer servers to run these AI computing servers, power generation is going to have to increase. And that's really interesting. And that's actually driven a lot of utility stocks that are ideally going to supply that power a lot higher. So I think this is an interesting slide in the sense that, you know, sometimes just because we're at all-time highs and have already had a nice run this year, that doesn't necessarily mean that we need to be that nervous. And so kind of the point of this slide is that if you look at the first quarter returns, anytime we've had a year where the first quarter of that year produced a market return of more than 10%, which, by the way, that happened this year, almost every single time except once, the market continued to move higher for the rest of the year. And that, in some respects, is the concept of momentum investing. So this actually shows every time we had the first quarter of any year where the stock market went up by 10% or more, which, by the way, it did this year. The orange bar shows what the market did for the entire year, which means, except in 1987, that was the only exception, the market didn't continue to move higher. And why? Well, 1987 is when we had the famous Black Monday market crash where the market dropped over 22% in one day. Quite scary for anyone who lived through that. But that's the only exception. So the bottom line is we have a pretty good reason to believe that the market may actually continue its momentum this year. Another source of comfort that I think people have to keep in mind is that there is a lot of money still sitting on the sidelines. I mean, I'm one of them. I admit it. I have a lot of money in sitting on the sidelines because I've been waiting for a market correction for over a year and a half. That hasn't happened. And so I'm not alone. A lot of other people have a lot of money sitting on the sidelines. And so what does that mean? Well, that means that anytime if we do have a market dip, whether it's overall in the market or even in individual stocks, there's a lot of money that jumps into that dip. So that is a mitigating factor. It means that even if we do have a market decline, there is a lot of money that is ready to jump into the market because we have record balances in the trillions of dollars sitting in cash or cash equivalents. That to me is pretty comforting. And the other question is, well, what is the market really doing? What's the market paying the most for? Right now, the market is paying a premium and is really searching for companies that demonstrate high margins, because companies that demonstrate consistently high margins are the ones that tend to do the best, even if we have consistent higher inflation, even if we have a market downturn. Higher margin companies tend to do a lot better. And which companies out there tend to have the highest margins? Technology companies. That is where a lot of the money has been flowing. So that actually means that I think it's really important to make sure that we have proper exposure to the tech sector. So what are we paying a lot of attention to now and moving forward? Well, obviously, is inflation truly coming down? I mean, yesterday we had a pretty good inflation number. But the question is, when will the Fed declare victory over their inflation fight? Because once they do, that will pave the way for them to cut rates, which everyone has been breathlessly anticipating, which just simply hasn't happened. The other thing we got to keep looking at is that unemployment rate. Now, it has started to come up. The question is it coming up for good? Because once it starts moving up, it tends not to stop. And if that happens, I think that's when we have to worry about the resulting negative impacts on the economy, because that means consumers will not be able to spend. That means things will slow down. So that, I think, is something to really keep an eye on. I do think that this is a great time for bonds. I love positive convexity. So I do think that, we always want to keep an eye on the bond market. But right now, the bond market is telling us things are pretty good, right? And I think the bond market is a really, really good indicator of, the health of what's happening with the economy. So right now, I think bonds are a pretty good place to be, because even if things do get choppy in the equity market, bonds aren't as volatile. Bonds are a lot safer than stocks. So having a nice allocation to bonds, I think, is a smart thing right now. Obviously, I think, all the headlines always talk about AI. Companies in their earnings reports have been talking about AI, even if they have nothing to do with AI. Every company thinks they have to talk about AI because everyone wants to know if they're leveraging AI. But I do think that we are really entering what I consider to be the fourth technological revolution that at least I've seen in my lifetime. And I think AI has a lot of potential to increase companies' productivity, increase their margins, and basically also, as a result, increase the stock prices. So I do think we are in a new artificial intelligence revolution that is really just beginning. And then last but not least, remember, even though there might be some reasons for concern about unemployment and labor and the economy, there's still a lot of cash on the sidelines that, that can jump into the market if things get bad. So that's a nice mitigating factor. And I think that's something we still want to pay attention to. And so what does all this mean for portfolios? Well, what it means is I think we want to stay basically neutral to slightly underweight equity. But within equity, we want to make sure that we have proper exposure to technology, because I do think technology is really an important sector right now. So in portfolios, you will notice we are increasing our exposure to technology. We're not increasing our exposure to equity overall. We're keeping pretty neutral to our benchmarks, but we do want to make sure we overweight tech because of the importance of those underlying trends we've been talking about. We're also going to be a little underweight mid-cap because, again, the strongest companies will do the best if we have some choppy waters moving forward. The strongest and biggest companies tend to have the highest margins. So we want to favor those larger sized companies over the more middleweight companies. And we also think the US is still really the place to be, which means we're going to be slightly underweight international versus the US. And as I was saying, we like bonds. So we are going to stay overweight bonds. And as a result, we're also going to reduce our exposure to cash or cash equivalents, as well as any alternatives, because now I don't think we need to worry about alternative exposure, meaning things other than stocks or bonds like commodities or whatnot. I think it's really important to take advantage of the fact that the bond risk return scenario moving forward is very attractive. We want as much exposure to that as a given risk profile will allow. So that's why we're going to stay overweight fixed income. So I hope that was explanatory, and I hope that all kind of made sense for everyone. And right now, we have some time, hopefully, for some questions.
Great. Thank you, Steve. That was great. Yes, as Steve mentioned, if anyone has any questions, please submit them. We did have a few questions for you, Steve. To start off, Steve, with all the talk of AI, have you actually seen how AI can help increase productivity in your interactions with businesses or any of your clients or in your world in general?
Yeah, that's a great question because, a lot of times people are like, I hear so much about AI, but I really have absolutely no idea how that's really working in companies. Like, what's the big deal? Well, the other day we were having an interaction with one of the consultants we work with. And, as you can imagine, we were actually doing a call like this on a Zoom call, and we were having a lot of dialogue back and forth. And the consultant who was running the call was fully engaged in the conversation, and they weren't even taking notes. And I was thinking to myself, how are they going to, make sure that we record all this, and how are they going to follow up on all the things we got to do? And the cool thing was that they had an AI chatbot in the background that was basically recording every single thing that we said, and then going through it and sorting what was the most important things we said and summarizing it, so that within 5 minutes after that call, we had an awesome summary of the call as well as all the follow-up items. And that, to me, was pretty darn efficient. And that was a great example of how that can make not just companies, but even individuals a lot more effective at what they do.
That's a great example. I have seen the meeting notes from AI as a new feature, and that's definitely a really good point of how people can use it to be more effective. Another question we had is, what do you think the Federal Reserve is going to do with interest rates for the rest of the year? I know you touched on this a bit, but what do you see?
Yeah, this is obviously a tough question, and there are tons of people who prognosticate about this for their whole careers. But I mean, like I said, I think the Fed is in a tough spot, right? Because, on the one hand, they've raised rates to the point where it's starting to hurt consumers, especially consumers on the lower income spectrum. Credit card delinquencies are up, mortgage rates are really high, and but inflation's still pretty high. I mean, they have an arguably their stated target is a 2% inflation rate. We're well above 3%, right? So they're not there yet. And most of that inflation is because of services inflation, as well as like auto insurance, things like that. So I don't know how easy it's going to be for them to get it down to the 2% level, because if they have to raise again, then I really think they're going to break something, right? When they rose, when they increased rates dramatically before, and we saw a couple of bank failures as a result, right? We have seen stress in the commercial real estate sector. So I really think it's going to be hard for them to raise rates. But if inflation stays where it is, I don't think they're going to have the luxury to cut anytime soon. I mean, at the beginning of the year, the market thought the Fed was going to cut rates like 4 or 5 times this year. As a matter of fact, they actually thought they were going to be cutting rates already. Obviously, that hasn't happened. Now the market thinks we'll probably be lucky if we get 1, maybe 2 rate cuts. And if that happens, it probably won't even be until the latter half of the year. So, and despite all that, despite the fact that at the beginning of the year, the market was anticipating rate cuts, which, by the way, the old adage is don't fight the Fed, meaning, the Fed is your friend in the terms of if they're cutting rates, that's great. And if they're raising rates, look out. Well, they're not cutting, but the market's still roaring away. So the Fed is seeing a really strong market. And they probably actually would prefer the market not to be that strong, because then it might give them a little more leeway to cut rates, because I think they are nervous that because rates are where they are and they see the pain that's inflicting on the average consumer, that's why they're in a tough spot. So, but and I have no idea what the Fed's going to do, but if I were them, I certainly wouldn't. I don't think there's any reason to cut right now because inflation's still high. You go fill up your gas tank, you go out to dinner. If you want to book an airline flight or take a nice vacation, you're paying a lot for that, right? Prices are still really, really high. So I think it's going to be interesting to see if and when they do make their first cut. And we're going to get a better idea, when they do their traditional Fed speak at their next meeting. But right now, I think at least the market is predicting basically two cuts this year, and maybe one late summer, maybe one in fourth quarter. That's kind of what the market's predicting. I wouldn't I would not bet too much money on that, but I think that's a reasonable prediction.
Great. Thank you, Steve. All right, well, if no one else has any questions, I just want to remind everyone that there will be a survey for feedback that will appear in your browser when the webinar ends. Please let us know any feedback for Steve, any recommendations, questions you may have. We're always willing to take your responses into consideration. And we will also be sending out the recording of today's webinar. So just so everyone knows, you'll have a copy of that. And to those who couldn't join us, we'll be sending that out too. So with that, if I don't see any more questions, Steve, any closing remarks before we close out?
Yeah, no, thanks everyone for your attention. Hopefully you found it interesting, and really welcome your feedback, because we always want to make these as impactful as possible. And as I was saying, the old market saying is sell in May and go away. Good thing we didn't do that, because May has been great. So sometimes those old market sayings just are old and should stay old. So hope everyone has a great rest of the week.
Great. Thank you, guys. Thank you, Steve. Thank you, everyone, for joining us today, and have a good rest of your day. Bye-bye.